Kevin Warsh has picked the absolute worst time to go quiet. The long-term rates did not love the Fed chairman's second statement given at the end of July, following the second FOMC meeting with him at the helm. Now, the FOMC held rates steady, as they have for months and months and months on end now, so that wasn't particularly new. But what caused long-term rates to spike was the lack of guidance coming out of the Fed about what happens next. That's what we're going to discuss in this video. Why are the bond markets mad that Chairman Warsh went quiet? Well, we need to start with a basic understanding of the yield curve and Fed policy. Now, I want you to take a second to really look and understand this chart, as it can be a little bit confusing. It confuses me all the time. So what we have in blue is the US yield curve, 10-year minus 2-year. However, it is inverted. So when it is moving higher on the chart and it looks like it would be steepening, that is actually flattening. And then vice versa, when it's moving lower, that actually means that it's steepening. We have it plotted with the Fed funds rate. And what you see is they generally move together over time. When the Fed is hiking rates or the market expects rate hikes, we get a flatter yield curve. This makes sense, as it's the shorter end of the curve that the Fed has control over. So if the shorter end is moving higher, you're generally going to get a flatter curve, and vice versa. What we've seen if we look at the clip chart here on the right is that the market has been expecting and pricing in rate hikes, right? So we have seen a flattening of the yield curve, the blue line moving higher, but we have not gotten those rate hikes. And in fact, you can actually see some of this confusion in real time if you look at the very end of the clip chart and see the steepening. So the market really doesn't know what's going on. And there's a reason for this. And it starts with the fact that the long end has already been stressed. It has been under pressure for a long period of time. Now, some of this is a return to normal, as these were off ZIRP lows, where the Fed had kept interest rates incredibly low for a long period of time. Now, I just said the Fed has more control over the shorter end of the curve, but that does flow through to the longer end of the curve. It does have some control. And what we've seen is long-term yields, specifically I'm looking at the 10-year and the 30-year, move up significantly over the last few years. Now, again, some of this is return to normal. This is not to say that these levels are necessarily high. They are high for recent history. There's a few reasons, again, besides the Fed raising rates, why the long-term yields has been under stress. The first has to do with fiscal spending. So the US has been running budget deficits since the early 2000s. President Bill Clinton was the last one who had us running a surplus. That was for a very short period of time. Before that, it was also deficits. But what this repeated deficit after deficit after deficit has led us to is that our interest expense on US debt is now actually higher than our payment on defense spending. So the US right now spends more on interest than on defense. So the first thing impacting long-term yields is the fiscal situation in the US. Investors now consider the US more risky and require higher yields for long-term government debt than they did previously. You can actually see this with over the preceding decade, how all of the major rating agencies have downgraded US debt to right below the tier of some of the top tier country-denominated debt. Number two, we have some long-term and short-term inflation factors that are weighing in here. So on the left, we have foreign-born workers versus domestic or native-born workers. And foreign-born workers have been dominating labor force growth over the last few decades. As you can see, the dark blue line here is native-born. That has been relatively flat since 2007, whereas the red line, foreign-born, has exploded in growth since that time. And that's really what's been carrying this teal line, which is total labor force growth, higher during this period. Now, if you zoom in on the end of the chart, you can see the red line has mainly stalled out. And that is due to more restrictive immigration policies that we've seen in the US over the last few years. Now, there are a lot of political implications of this that I'm not going to get into. We talk policies, not politics, as I have said before. However, when you look at the supply side of the employment picture of the US, at a time when boomers are retiring at increasing rates, the labor force participation rate is falling, cutting off the fastest growing part of our labor force adds questions about our labor force growth into the future. It makes things a bit more risky and a bit more inflationary for wages. And then we also have shorter term inflation spikes having to do with the Iran war and also tariffs. Let's not forget tariffs. I don't have it here, but we just got a new tariff on Canada. So that is always something that could potentially be popping up for the last few years as well, that the market has to contend with. But more concretely, we have the Iran war, which has led to a direct inflation spike. You can see the relationship between oil prices and headline US CPI. And as oil prices went up, we unsurprisingly got a spike in CPI. So again, we have the fiscal situation, we have inflationary prospects that are all adding stress to the long end of the curve. Finally, we have what's been going on in Japan. So if you look here at the chart on the right, the yen has been losing value fast compared to the US dollar. So much so that the US is now intervening to support the yen. Now you might ask, why are they doing this? Well, President Trump has said it's because Japan is friends to us outside of Pearl Harbor. However, I don't know if that's actually the reason. The reason for this is because if Japan goes to support the yen itself, they will do that by selling US dollars. How do they do that? That's by selling their treasury holdings. And they are, I believe, as I record this still, the largest foreign owner of US treasuries. So now, if they are going to sell off these treasuries, that puts pressure on US yields, right? If people are selling it, that means the yields move higher. Now, we have not gotten an update for this number chart here on the left since March of 2026. There are some anecdotal numbers out there, but I'm only going to use official numbers. But right now, what the whispers are is Japan had accelerated this selling, which again is not going to show up on this chart. And that is what spurred the US to intervene to help support. But that is more conjecture at this point. However, the selling has happened over the last few years. They have sold hundreds of billions of dollars worth of US treasuries. So that brings us to the macro regime leading into the FOMC meeting that we just had at the end of last month, and why Chairman Warsh is adding to the uncertainty. So you might say it's because of the three dissents, right? The FOMC is not together right now. However, more recently, that has not been that big of an issue. We are now sort of used to the dissents. We've had dissents going in different directions. This was three dissents all in the same direction, asking for a hike. So that in and of itself, at least in recent history, is not really news. I think the market knows how to digest some disagreements within the FOMC. However, what the markets seem not to like is the lack of information in forward guidance that Chairman Warsh is giving the markets. So I've compared Chairman Powell's statement length, and I'm specifically talking about the policy text here. The policy text statement length compared to Warsh's. And as you can see, there is a huge difference, an over 200 word average difference. Now, again, Warsh has only had two, so this could expand over time. Chairman Powell had a lot more than two. But what we have seen is that the market has sort of been left for dry, left out to dry, left out to drown, whatever the phrase is, looking for information about what comes next for the Fed. And Jerome Powell was very explicit with these long statements about what the FOMC was thinking, what was going to potentially come next. Now, people have complained about that as well because the Fed does get it wrong. But Warsh has taken the complete opposite of this and has basically given no information about what comes next. The market has been left to try to figure it out for itself. So, what does the market think is next? I don't remember a time where leading up to a meeting that it was this close to 50-50 about what was going to happen. Now, to be fair, this meeting is not until September. We don't have an August FOMC meeting. But right now, it's 45.5% for rate hike and 45.5% for no change. This comes from the CME Fed Watch tool. People are very unsure about what's going to happen in September. The market still does think that one hike is very likely in 2026. As you can see how this has changed over the year. At the beginning of the year, it was almost certain we were going to get a cut. Now it's about 80% certain that we're going to get at least one hike. But this uncertainty, at least near term, still exists. And that's sort of what you've seen. So you've seen a macro regime that was already adding pressure and stress to the long end of the curve, sending 10-year and 30-year yields higher. And then you have a Fed chairman like Kevin Warsh, who has completely removed forward guidance and added uncertainty on top of this stress. So in response, long-term yields moved higher. That's what we'll leave you with today. I hope you enjoyed this video. If you learned something new, it would be great if you could take a second to subscribe to the channel. And I will see you back here next week with another Macro Monday video.